The world is changing, and investors around the world are becoming more sophisticated, demanding innovative solutions from wealth and asset managers. Combining our deep expertise and experience in both investment and wealth management, Manulife Investment Management offers fully integrated solutions spanning investment funds and pensions globally. Strategically positioned in key markets, our investment and client service operations are supported by seasoned investment professionals across the globe. Today, we are one of the leading global wealth and asset managers. What sets us apart is our 3 complementary global business lines to meet the unique needs of our clients. With our multi-product and multi-channel offerings, our retail investments arm brings institutional capabilities to retail investors, creating unparalleled investment solutions. While our institutional asset management arm provides a comprehensive suite of outcome-oriented solutions to institutions internationally. Our retirement arm offers an open architecture platform, which aims at providing best-in-class products and end-to-end solutions to meet the varied retirement needs. Leveraging the strength of our parent company, Manulife Financial Corporation, which has a rich heritage and investment track record that dates back to the 1800s. We have access to a wealth of experience. With our strong insurance pedigree, we manage risks in a strategic and dynamic way. In Asia, our unrivaled presence and deep understanding of the region enable us to offer strong local insights and flexibility in customizing solutions for every client. It is our unwavering commitment in Asia that makes us a trusted partner of many across the world. Leveraging our local-level expertise, as well as extensive global resources and network, we deliver solid investment results not just in public markets, but also private markets. Our long track record and deep capabilities in private assets means you can tap into a diverse group of assets to meet your unique investment needs. Through our differentiated, value-added public and private asset offerings and capabilities, we punch above our weight in delivering outcome-oriented and goal-based investment solutions to our clients. We achieve excellence in Hong Kong, where we power the largest mandatory provident fund provider, Manulife, and China, where we are the first financial institution to receive the investment company wholly foreign-owned entity license. The Philippines, where we are the first trust corporation backed by a leading multinational financial services group. And Indonesia, where we were awarded the top fund house. And this sums up our commitment to you. Manulife Investment Management.
Bro, anong gagawin mo pag nagkaroon ka ng milyones?
Magnenegosyo.
Anong business?
None of your business.
Eh kung mag-around the world na lang kaya tayo?
Saan ang unang punta natin?
Sa airport.
Nakareceive ka naman ng mga text na get rich fast?
Medyo alangayin ako sa mga ganyan.
Our goal should never be of the clandestine, to meticulously invest in that result in favorable ROI. And the thought alone gets me absolutely exhilarated.
Ha?
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 Kung yayahin ko na lang kayang makapag-date si Hart.
Kasal na yun, oy.
Aba, imagine lang naman eh.
Pag ikakasal na kayo, siguraduhin yung malapit kayo sa torre ng telco.
Bakit?
Para maganda yung reception.
Alam ko na. Ipapa-plastic surgery ko na lang yung mukha mo.
Pero,
Walang pero, nakakainis lang kasi itsura mo. Eh kung magpakain na lang kaya tayo sa mga kapuspalad.
di tropa din natin, tsaka pamilya yung pumunta ron. Pa-family reunion ka na lang sana.
Magtatayo na lang ako ng gym.
Bakit gym?
Para mag-workout lahat ng plans ko.
Ano bang plans mo?
None of your business.
Talent, position please.
Ready, direct!
3, 2, 1, action! And cut!
Buti na lang naisip natin to.
Dali lang pala.
The world is changing, and investors around the world are becoming more sophisticated, demanding innovative solutions from wealth and asset managers. Combining our deep expertise and experience in both investment and wealth management, Manulife Investment Management offers fully integrated solutions spanning investment funds and pensions globally. Strategically positioned in key markets, our investment and client service operations are supported by seasoned investment professionals across the globe. Today, we are one of the leading global wealth and asset managers. What sets us apart is our 3 complementary global business lines to meet the unique needs of our clients. With our multi-product and multi-channel offerings, our retail investments arm brings institutional capabilities to retail investors, creating unparalleled investment solutions. While our institutional asset management arm provides a comprehensive suite of outcome-oriented solutions to institutions internationally. Our retirement arm offers an open architecture platform, which aims at providing best-in-class products and end-to-end solutions to meet the varied retirement needs. Leveraging the strength of our parent company, Manulife Financial Corporation, which has a rich heritage and investment track record that dates back to the 1800s. We have access to a wealth of experience. With our strong insurance pedigree, we manage risks in a strategic and dynamic way. In Asia, our unrivaled presence and deep understanding of the region enable us to offer strong local insights and flexibility in customizing solutions for every client. It is our unwavering commitment in Asia that makes us a trusted partner of many across the world. Leveraging our local level expertise, as well as extensive global resources and network, we deliver solid investment results not just in public markets, but also private markets. Our long track record and deep capabilities in private assets means you can tap into a diverse group of assets to meet your unique investment needs. Through our differentiated, value-added public and private asset offerings and capabilities, we punch above our weight in delivering outcome-oriented and goal-based investment solutions to our clients. We achieve excellence in Hong Kong, where we power the largest mandatory provident fund provider, Manulife, and China, where we are the first financial institution to receive the investment company wholly foreign-owned entity license. The Philippines, where we are the first trust corporation backed by a leading multinational financial services group. And Indonesia, where we were awarded the top fund house. And this sums up our commitment to you. Manulife Investment Management.
Bro, anong gagawin mo pag nagkaroon ka ng milyones?
Magnenegosyo,
Anong business?
none of your business.
Eh kung mag-around the world na lang kaya tayo,
Saan ang unang punta natin?
sa airport,
Nakareceive ka naman ng mga text na get rich fast?
medyo alangayin ako sa mga ganyan.
Our goal should never be of the clandestine, to meticulously invest in that result in favorable ROI. And the thought alone gets me absolutely exhilarated.
Ha?
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 Kung yayain ko na lang kayang makapag-date si Hart.
Sal na yun, oy.
Aba, imagine lang naman eh.
Pag ikakasal na kayo, siguraduhin yung malapit kayo sa torre ng telco.
Bakit?
Para maganda yung reception.
Alam ko na. Ipapa-plastic surgery ko na lang yung mukha mo.
Pero,
Walang pero, nakakainis lang kasi itsura mo. Eh kung magpakain na lang kaya tayo sa mga kapuspalad.
di tropa din natin, tsaka pamilya yung pumunta ron. Pa-family reunion ka na lang sana.
Magtatayo na lang ako ng gym.
Bakit, Jim?
Para mag-workout lahat ng plans ko.
Ano bang plans mo?
None of your business.
Talent, position please.
Ready, direct!
3, 2, 1, action! And cut!
Buti na lang naisip natin to.
Dali lang pala.
In an environment where optimism on a strong global economic recovery is merged with concerns on the lingering COVID-19 pandemic, more and more investors are searching for diversification. Good afternoon, everyone. This is Discovering New Horizons, Opportunities in Global REITs and India Equity. I'm Ned Chanko from the Wealth Sales team of Manulife Investment Management Philippines, and I will be your host today. We often hear about the power of diversification, and this is indeed true. In today's economic landscape, diversification is one of the most important strategies that can help you minimize risk and achieve your long-term financial aspirations. This prompts us at Manulife Investment Management Philippines to introduce new investment solutions that will help you grow and diversify your portfolio. We've got two financial experts joining us this afternoon to talk about investment opportunities that await you in Global Real Estate Investment Trust, or REITs, and India Equity, one of the fastest growing economies in the world. We are also giving away 5,000 pesos worth of investment to our best-in-class funds to help you start your investment journey. So stay tuned for that. Let me now introduce our esteemed speakers for today. Live from Singapore, he graduated Bachelor of Commerce with honors in accountancy with a postgraduate in business administration, finance. He is now a senior portfolio manager, India Equity Specialist, responsible for the research, analysis, and coverage of Indian equities for the India Equity Strategy and regional portfolios. He works closely with the Hong Kong-based investment team and teams across Asia to facilitate real-time information flow. Rana has over 20 years of experience in portfolio management and research for Indian equities. Ladies and gentlemen, say namaste to Rana Gupta.
Hello and good evening to all. Thanks for your interest in India Equity Strategy. I'm looking forward to share the key highlights and attributes of the same with you over the next course of 1 hour or so. Thank you and welcome to this.
Thanks a lot, Rana. So up next, we should really thank him because he woke up really early for us, all the way from Boston, Massachusetts, where it's about 4:30 a.m. He graduated Bachelor of Science in Finance from Bryan College and obtained his MBA from Bentley College. He is now Managing Director and Lead Portfolio Manager for the Global Real Estate Strategy at Manulife Investment Management. His 25 years experience in the investment management industry complements his other functions as a member of Manulife's Capital Appreciation team. He also provides fundamental research on the real estate sector for the Capital Appreciation team's $13 billion in managed assets. Ladies and gentlemen, please welcome Joseph Margay.
Thank you, Ned, and thank you everyone for joining this afternoon. I look forward to sharing the positive attributes of global REITs and why it should be considered a part of your portfolio. Thanks again for having me.
That's great. Thanks for that, Joe. Before we begin our program, I would like to encourage everyone to please join in on our conversation. Anytime you have comments or clarifications for either of our guests, please go ahead and type in your thoughts in the Q&A box in the bottom right-hand side of your screen. Our panelists will try to address them, if not all, during the Q&A session after their presentations. Now, I'm sure our viewers are interested to know more about these funds and how these can help diversify their current portfolios. Let me start with you, Rana. India is an economic powerhouse offering investors attractive growth opportunities. Can you tell us more about the features of India Equity and what investors can look forward to in this fund?
Sure. Thanks, Ned. Thanks for the opportunity. Firstly, we would like to highlight that India offers very sizable and sustainable growth opportunities. The size of the economy is near $3 trillion, and we believe because of the reforms that has happened over the last 5, 6, 7 years, a nominal growth rate of something like 12-13% is sustainable. So which means a $3 trillion economy, when it grows at 12-13%, that adds a lot of value. And in India, because of the reforms that has happened, we believe that the corporate sector will be able to capture a major part of this, thus driving the value creation in the company's profit growth and maybe even a buoyant stock market. Now, let me also give a bit of a background because I mentioned about the reforms that has happened that will sustain this kind of growth. So I will pick just 2 reforms in particular. In 2014, Indian government embarked on the journey of formalization. Previously, India was a largely informal, small-scale driven, cash-based economy. The formalization was more of a part of bringing the economy into a more modern, accountable framework. Now, formalization was helped by unique identity number for every citizen, linked to their bank account, and by that time, also the 4G network started spreading all over India. So, and also the cheap mobile phone handsets came in. So, as a result, it is now possible for someone using formalization to do more and more digital transaction. In effect, formalization has paved the way for digitalization, and that is now growing by leaps and bounds. Whether it's the food delivery, whether it's in transport, whether it's in medicine, various areas are now coming under digital economy, and we are seeing accelerated growth. So that's going to be one great opportunity, and that's what we mean when we say the stronger economic foundation is now there because of the formalization efforts. The other reform that we would like to highlight is that the growth rates are getting supported by government's initiatives like recycling, rebuilding, and reinvestment. Recycling is basically government selling its own stake in different assets, including state-owned companies, and using that money, they are because they have that money, they are able to give tax cuts, which is rebuilding the savings of the corporate as well as the household. Not only that, because the fiscal situation is now quite good and getting better, the government can also now support reinvestment activities for the corporate by giving them lower tax rates, giving them production-linked incentives. Basically, the objective of the government is to give enough incentive for the private sector to build manufacturing in India. This is also has been a core priority area because if you look at in case of India, a lot of it's a large consumer market. Everyone knows that, but a lot of stuff is to be imported from China, Southeast Asia, and other countries. This government has taken these policies so that more and more is manufactured locally. Thus, the value is captured within India. So, to summarize, the two impacts: the more and more digital economy and formal economy, and more manufacturing. This will drive productivity and growth within India for the foreseeable future, for next 3 to 5 years. Next slide, please. And why the Manulife India Equity Strategy? So this strategy has a very long-term, 3, 5, 7 track record of being in the top quartile, and it is not only the return because of a process we have been able to manage the risks as well. So our process has enabled us to get to these themes, identify stocks which has maximum leverage to those themes, get harvest the return while managing the risk. Additionally, we have now integrated our process with ESG approach, and the way it's going to help us is because we believe that the markets are fairly inefficient as far as discovering sustainability trends are concerned. Indian markets are still in the early stages of adapting to environmental and social norms. But because of our research, bottom-up research, we get in touch with companies who are turning these environmental and social risks into opportunities. So as a result, once they turn these opportunities, we are seeing some sort of higher investor interest, re-rating of those companies. So therefore, there are enough number of opportunities in the equity markets to capture the trend that we have just spoke about. Next slide, please. So the next slide basically captures the what we were talking about in terms of formalization and reinvestment and reinvestment recycling. These two themes. Now these two themes also interact with each other. Let me explain. The blue circle, which started with formalization, has now given rise to a vibrant, growing digital economy. Now, as more companies become digital, they benefit, they get more customers, and their top lines grow, the profits grow. The companies who have not yet formalized, they see the deficit. So in turn, they also go and formalize themselves. They start paying proper taxes. they start doing the business proper way. So formalization, what started as formalization has pushed digital economy, and the vibrance of the digital economy now in turn pushing further formalization. As a result, productivity is improving. Many new opportunities in the stock markets are getting created, but also more important and most importantly, more and more companies formalize, which means more and more companies are also coming under tax net. That typically means the governments will collect more revenue both in direct and indirect taxes. As a result, fiscal situation of the government will improve. Therefore, the government will have money to invest in infrastructure without running a higher fiscal deficit. The next circle, the green one, is basically the green one. It is about because the fiscal situation is now stronger, the government could give various incentive to the producers to produce more in India, to cater to the local market in India by import substitution, and as well as address the export market. We are seeing, all the global giants that you can think of, whether it's Samsung and LG or the Chinese, even bigger Chinese companies, they are now all putting up local manufacturing capacity in India. And this is indeed, and we see the manufacturing as a percentage of GDP rising. Imports are going down, exports are going up. What is the result? The result is India, previously because of its higher import, always ran a large current account deficit. No more. So we see, because of these two reforms, both current account deficit and fiscal deficit getting addressed in a structural way. So the deficits of the country will come down. That will also set the foundation for strong virtuous cycle of growth. And as evident, that as more and more the digital economy grows, the more and more manufacturing grows, there will be better quality jobs. And better quality jobs in turn promote better consumption, and the whole cycle, virtuous cycle carries on. So therefore, we are very excited about the opportunity that lies ahead, created by reform. We see adequate opportunities in the stock market to capture this, and we believe our process, coupled with the ESG integration, we are positioned to harvest the returns as well as manage the risks that may be involved. Back to you, Ned.
Very exciting indeed, Rana. With India's growth opportunities, transformative reforms through formalization, and strong potential for digitalization, we look forward to seeing this fund deliver growth for long-term investors. Now, another equally interesting opportunity is global REITs. Real estate investment trusts are historically one of the most consistently performing asset classes. Joel, can you tell us more about the features of global REITs and what investors can look forward to in this fund?
Thank you, Ned. Absolutely. On this slide, I would like to share really the 5 key reasons why investors should consider investing in global REITs. Number 1, REITs offer a long history of stable and growing dividends. And given the low interest rate environment that we currently find ourselves in and have found ourselves in for the last few years, investors' demand for yield remains very strong. REITs remain a great alternative, for yield-seeking investors. Secondly, long-term investment growth. The ability to also participate in the broader equity markets. REITs have that hybrid attributes of not only generating strong income, but the ability to have capital appreciation as the markets move higher, usually driven by stronger economic performance from the global economies. And they've shown a strong history over multiple market cycles, outperforming the broader global equity markets. Third, when investors add real estate to their overall portfolio of diversified equity and fixed income funds, we find that it lowers volatility because it enhances their diversification. Fourth, investors gain exposure to not only the broader equity markets and broader economic conditions, but they're also getting exposure to what we have identified in terms of current and long-term trends, from an economic recovery post-COVID pandemic to the evolution of technology and the continued development of new technologies in the world's aging population that we believe REITs are ripe to capitalize on. And lastly, by investing in global REITs with Manulife, you gain access to an active management team with deep expertise that can provide strong stock selection and facilitate attractive yield and return opportunities. On the next slide, we'll illustrate just how well the global REIT market has performed over the last 20 plus years, producing strong returns of almost 10.6% compared to the broader global equity markets represented by the MSCI World Index that generated the return of 6.13% in that same period. One of the most important takeaways from this slide is just how much of that return from the global REIT market has come from dividend income. We know investors are searching for yield and have been for years and are expected to continue to do so, but you get more than half of that return over the past 20 plus years in the form of dividend income at 5.44%, which is truly impressive considering where yields are today. On the next slide, we show a correlation matrix of how global REITs have moved in tandem with other asset classes that might be in one's portfolio. And on this chart, you can see just how low correlated the global REITs are to whether it be Asian equity or Asian bonds or to world equity and world bonds. And so by adding global real estate a part of an overall investment portfolio, it helps diversify the portfolio and reduce volatility. On the next slide, we highlight some of the trends that we are focused on as a management team here at Manulife. We believe the REIT sector can quickly capitalize on these trends that will ultimately drive strong earnings and cash flow growth over the next year and beyond. The first two trends will play out for the long term. These are multi-year events. We have seen over the past few years an explosion of new technologies, whether it be automated intelligence, autonomous driving vehicles, the continued evolution of mobile devices. Imagine what we were using for mobile phones just 5 years ago and look at what we have today. It's truly remarkable, the rapid development in technology. And we've also seen continued growth in e-commerce, even more so over the past year and a half as the pandemic has forced many of us to shop from home and avoid going out into public or even to retail establishments. But that trend was already rapidly developing prior to the pandemic, and we believe it will continue even beyond the pandemic once we get beyond it. We believe that e-commerce growth is going to continue to drive demand for warehouse and logistical assets, which our warehouse REITs have prime portfolios that are seeing that in tremendous growth in rents and occupancy. From the technology side, just doing this webinar and coming through crystal clear as I'm halfway across the globe, hearing me very clearly, seeing my face very clearly, you couldn't do that without a strong telecommunication network. And the cell towers and the data center REITs that provide those services to the telecommunication providers are vital to making this event happen. And it's been vital for us to be able to work in this stay-at-home environment over the past year and a half. And we think demand on these technologies is only going to continue once we get to the other side of this pandemic, and the demand for real estate assets that service the technology industry will continue to grow. The next trend is the world's aging population. We are all getting older. As much as we want to fight and stay young at heart and continue to hang on to those younger youthful years, we're all going to get older. But we want to live longer and more productive lives. So we're going to demand more out of our healthcare infrastructure, whether it be medical centers and hospitals to get that preventive care or the necessary care that we need, or is it the retirement homes that are going to, find ourselves living where we're demanding more amenities, where we get either recreational amenities or dining amenities, so that our children may not have to take care of us in our elderly years. So we want to live much more productive and fruitful lives as we hit our retirement age years, and we think the REITs globally are primed for strong development opportunities over the next few years. Lastly, the economic recovery and post-COVID-19 impact on real estate. We've seen a lot of shifting behaviors by consumers and businesses over the past year, and we want to be able to position the portfolio accordingly. As we get beyond this, hopefully this pandemic's a lot sooner than later, as we get the vaccine rollouts further out across the globe, we believe that the first REITs that will recover the fastest will be those in residential, industrial, and retail REITs. And we want to be well positioned for them as we monitor the economic data, as we hopefully are starting to see some economic recovery, and we're well positioned to take advantage of them. Back to you, Ned.
Income and diversification are indeed two benefits that most investors are keen to have during these times, Joe. So this fund will truly be a great match for them. For my next question, let's take a look at COVID-19. While some countries are on their way to full vaccination and full reopening of economies, most of us here in Asia are not there just yet. Rana, could you let our audience know how COVID-19 affected equities? How did you manage superior past performance? And how will you position for the future?
Sure, that's a great question, Ned. And before I answer this question specifically, also let me tell you that if I refer back to my last answer, where I spoke about themes like digitalization and manufacturing, these things were happening in India since about 2014, 2015. But these two themes really got accelerated during COVID times. As you would understand, because of COVID, digital economy grew. I think that's very intuitive to understand. On the manufacturing side, because many multinationals now resorted to a view that they need to have an alternative sourcing arrangement and move to a China plus one strategy, they also find India as a good market to produce something, manufacture and export to the countries. So first I want to say that COVID has helped accelerate and give further strength to both these two macro themes. So therefore you have seen that Indian equity markets have remained resilient, and the stocks geared to these themes, which is also structurally very good, continue to perform. Now, coming to slide 9, the slide on your screen. Additionally, I think the cyclical outlook is also quite good, because when COVID impacted the part of informal economy that remains, when COVID impacted them, when there was shutdown and certain part of the businesses, certain segments were impacted. As a response, RBI ramped up money supply, and also the rates were cut quite aggressively. Right now, although M1 growth is coming up from its high, but the money supply growth is quite high, and the real rates are a small negative number. Now, this is in a situation where the economy is recovering. So I think all this makes, all this kind of adds together to a buoyant outlook for asset markets and prices, which we believe is going to happen. And once the recovery from the COVID, which has already started, and we think is going to get further strength underway. Now, having laid the broad financial structural and cyclical outlook, which both of which are positive, let's look at COVID as such. How is COVID impacting India as of right now? So if you can move to the next slide. The next slide is about the COVID second wave, which was a big concern in India until some time back. You can see the second wave rose very sharply, but came down equally sharply. Right now, the infection numbers in COVID is more than 90, is less minus 90% since the peak. Active cases have declined. So one can see the COVID second wave has significantly subsided, as you can see in the chart. We can move to the next slide. I'll just spend maybe a few seconds on this slide, which shows that COVID-19 second wave, it will be transient, and in this second wave, it's sharper. It rose very sharply, but mortality is similar to the first, or maybe even slightly lower. But I think from here on, what we should be focusing on in case of countries which can produce vaccine of their own or can procure vaccines for their own, not so much on the virus, but on the vaccine, which I will cover in the next slide. Next slide, please. Okay, so we have run numbers on the vaccine capacity and other things. So India has significant vaccine capacity and enough to immunize the entire local population. Our work shows by December 21, total 1.2 billion dosages will be given. Given that 2 doses are required, so a majority portion of Indian population will be vaccinated by December 21. And we are monitoring this, and we are happy to report that the situation on the ground is progressing similarly. So if you move to the next slide now, we believe that the COVID, the urban India, the top 50 cities where mostly the economic activity happens, there the adult population particularly will get fully vaccinated by nearly October. And looking at the time frame, maybe October, November, you will have vaccination almost fully done for majority of the population in the urban centers, adult populations. What this means is that that definitely by December or December, January next year, normal life can resume. And when that resumes, economic momentum will come roaring back. So that also strengthens the cyclical outlook. So I think to summarize this point, I would say that COVID has helped accelerate the two structural themes: digitization and manufacturing. And because of the proactive policies of the government and the Reserve Bank of India, the monetary policy is benign, and we are, because of the vaccination situation, we are looking at the economy bouncing back pretty strongly, even as we speak, and it will get garner further strength. So even the cyclical outlook looks quite good. So if you move on to the slide 15 now, the next slide. So going forward, we would think that the performance of the equities will broaden out, and more sectors will participate. This slide just shows that over last 7 years, how different sectors have contributed. We would expect the similar trends to continue. And just on the last slide is our. Please go to the next slide. Yeah, so this slide just captures our performance over last several years, and this just adds to the point, what we were discussing, that there are enough opportunities, but there are risks. But our investment process helps us to manage the risk while deliver superior returns, and we are very confident we will be able to repeat that on a sustainable basis. Back to you, Ned.
That's really good to hear, Rana, and I'm sure it's an added comfort for our audience to know that India can counter the second wave with effective vaccine rollout. I'm also interested to hear from you, Joe. How's the performance of global REITs, and how have you managed to deliver positive results amid the challenges in real estate markets across the globe?
Thank you, Ned. No question, the past year and a half has been truly very challenging, both from personal level, the tragedy that COVID has unleashed on the world. It's been, very unsettling. But from an investment standpoint, equally as challenging. When the pandemic began, early 2020, we shifted to become more defensive. We wanted to be in REITs that we thought would be limited impact as a result of economic restrictions and economic shutdowns. So we focused on industrial REITs, the data center and tower REITs, given that we were going to be doing a lot more work from home, stay at home environment. The need for technology and the telecommunication infrastructure, we're going to see very limited impact at all or disruption from the pandemic. But as the year progressed and as cases, we hit that first wave and started to come down from the first wave, and news was coming out about development of vaccines and the progress that was being made. We wanted to be able to reposition the portfolio to take not only the profits from the industrial and data center sectors that performed extraordinarily well during the pandemic, but be ready for that shift towards an economic recovery. And so we redirected a lot of our proceeds as we locked in those gains to the retail, to an underperforming retail subsector. On the next slide, as the year progressed into 2021, the positive news of the vaccines came out. The early rollout in late 2020 here in the U.S. and into 2021 really led to an easing of restrictions here in the U.S. and we saw a lot of pent-up demand from the consumers getting back out, being able to go out and shop, being able to go out and eat in restaurants again. And we really saw a robust economic activity. So we continued to take profits in some of the sectors that worked well, and some of the names, especially it's a common theme. The industrial was a big weight in 2020, so we continued to lock in those gains and continue to redirect even more to those reopening theme subsectors, adding more to retail, adding to the residential REITs, especially here in the U.S. As during the pandemic, many people left the urban city centers, either because of the offices also shut down, but they also didn't want to quarantine in New York City or San Francisco in a 800 square foot or 80 square meter living facility. They moved either back to their parents or to the suburbs. And so those sectors were hit extremely hard during the pandemic. And we believe that the valuations were so depressed with the prospects of this positive development with vaccines and the cases that we were seeing in early 2021, we wanted to be well positioned to take advantage of the turnaround. And as you can see on the next slide, the performance has been quite strong over the past year and year to date. Year to date, we've posted an 18.34% return. In the 1 year, just over 39%. As we know that the vaccine rollout has been uneven across the globe, and that in having a global mandate, we've been able to be more flexible in redirecting our proceeds and our positioning in the fund to where we see the best opportunities in terms of what's happening on the ground from an economic standpoint, as well as redirecting into the individual subsectors that we're going to benefit from that positive development of the vaccine and the vaccine rollout, whether it be in the UK, the US, and elsewhere. And we're continuing to monitor, as Ron had pointed out, developments of vaccine rollout in India, and the cases there has been very encouraging. So we're monitoring other countries as time progresses and making investment decisions that are prudent to take advantage of what we believe is going to be the same type of reopening strength in other regions as they hit that critical level of mass vaccinations. Back to you, Ned.
That's wonderful, Joe. Active management is truly vital in this present market environment, and the fund performance showed this. Joe, I will stay with you for this question. Can you share with us the global real estate strategy of your team so we will have a better idea of what we can expect from this fund?
Absolutely. The Manulife Global REIT Fund looks to provide investors exposure to an asset class that offers an attractive yield when you compare it to other yield-oriented investments, whether it's global bonds or government bonds. We believe it's an attractive alternative for investors to consider. We start off with our philosophy that investing in undervalued real estate companies that provide sustainable cash flows and earnings growth can lead to strong capital appreciation and income generation over the long term. That leads us to look at REITs with strong business models, the ability for these REITs to capitalize on the opportunities they see to ultimately generate strong cash flow and earnings. We know investors continue to search for yield, as we do as well, but we need to see sustainable distribution growth as well as coverage. We want to make sure that those dividends are sustainable and have the ability to grow over time. We don't want volatility in our distributions. We look at the management teams at the REITs that we consider. We want strong management teams with strong proven track records that are continuing to evolve, incorporating ESG into their business strategies. We want them to be forward-looking, looking to take advantage of what they're seeing happening on the ground within their assets and within their portfolios to take advantage of potential growth opportunities. And ultimately, we want to position our fund to be able to take advantage of the favorable market conditions wherever that might be around the globe, and especially to the specific asset class, whether it be office, retail, or industrial. On the next slide gives you a little bit more of a highlight of our investment process, of how the management team here at Manulife comes up with a portfolio construction of global REITs. We use a blended approach using a top-down view and a fundamental bottoms-up approach to identify attractive markets and attractive REITs. We look at the current economic environment. We look at the interest rate environment. What are the policies of central banks around the world? What are they signaling? And what is their current approach? We look at inflation, government policies, anything that might impact the economy or the real estate markets that we're investing in. From a bottoms-up perspective, we look at traditional valuation metrics, whether it be price to earnings or price to book value, or REIT-specific measures that people may not be as familiar with, but net asset values. It's another very similar to a price to book ratio. We look at yield, as we know that it's important for our investors that want that strong income generation, and so we look at distribution rates and payout ratios where we can find other opportunities as well. Throughout that screening process, we assess where the most attractive markets are, what particular subsectors within the REIT sector looks attractive, and we're able to see which REITs provide the best opportunities for the fund. We perform an extensive company analysis to see if that individual REIT warrants a position within the portfolio. We talk to the management teams. We'll do on-site visits when it's appropriate and when we actually can do it. It's been a little bit more difficult over the past year, but we've been very creative in doing virtual tours, similar to doing this type of webinar. So we're able to still get a view of the portfolio and be able to talk to local management teams as well. We utilize a 6-factor fundamental research framework that each REIT is evaluated, which includes analysis of the company's assets in the markets they operate in, the management team. We look at the board structure, the compensation structure, their ESG policies, and the balance sheet is extremely important to us to examine as well. Once through that process, we select the REITs that meet our requirements and determine evaluation. If it's appropriate, we'll take a risk reward. We'll take a look at it from a risk reward basis and come up with an appropriate position size to prudently construct a well-balanced portfolio. On the next slide, you can see a snapshot of the portfolio as of June 30th, 2021. We believe we structured a portfolio that's well-balanced with an emphasis on value and yield, as you can see in the statistics on the top part of this chart. Our price-to-book ratio and our price-to-earning ratios are well below the broader global REIT index. We also have a substantially higher dividend yield that we're offering our investors, which is a very attractive 4.79% as of June 30th, compared to 3.14% of the broader index. Our top 10 holdings are listed below. That represents about 20% of the portfolio, so we have a well-diversified portfolio. And it's well-diverse not only regionally, but also among the subsectors. Starting with Simon Property, RioCan REIT, and Link REIT. Those are 3 retail REITs that operate in the US, Canada, and Hong Kong. We also have 2 global industrial REITs, Prologis and Goodman Group. We have a data center REIT, one of the largest global data center REITs in the world, Digitally Realty Trust, which has operations across the world, with more than half of its income and earnings coming from outside of the US. We have Stockland Group, which is an Australian REIT that is diversified, owning properties in office, industrial, residential, and retail. And then we have specialty REITs, such as Innovative Industrial Properties, which focus on a niche industrial warehouse space here in the US. And on the next slide. The next slide gives you more of a feel of what you would get when you invest in the Manulife Global REIT Fund, as you can see from our subsector allocation as well as regional allocation. 60% of the portfolio comes from our 3 biggest overweight positions currently as of June 30th. The industrial REITs represent about 20% of the portfolio, with retail just under 20%, and diversified rounding out our overweights. These really fall in line with our themes of reopening. We believe the industrial REITs will not only benefit from the continued developed growth of e-commerce, but we also know the post-COVID-19 impact is going to change the way manufacturing is being done. We're going to see a lot more local manufacturing take place closer to customers and closer to their distribution partners. And so we're going to see an increase in demand for warehouse space as supply chains for manufacturing gets reconfigured. We're also going to see continued demand from e-commerce that's continuing to drive significant demand as customers and consumers continue to want and like that convenience of shopping online. The retail REITs we're very selective on. We do focus mostly on the necessity-based retail REITs that have a food component or a service component that really showed its value during the pandemic. These are assets that really didn't shut down during the pandemic, as they were vital to the population in order to get our groceries, our food, or any potential essential services. We do own some selective mall REITs, but we're looking at quality, the strength of their balance sheet, and these are this sector we're seeing the best value in terms of relative value versus other sectors, and also excellent yield opportunities. The same with diversified REITs. We're seeing good value and good yield. Where we're a little bit concerned and where we have our underweights within the portfolio are the office REITs and the hotel REITs. We believe these sectors are going to take a little bit longer to recover on a post-COVID-19 world, even with mass vaccinations hitting a critical point. There's still a lot of uncertainty with what the future of office will look like. Many companies around the world are embracing a hybrid model, and given the uncertainty with the recent rise in the Delta variant, a lot of return to office plans have been pushed back, especially here in the US and elsewhere. So there's still a little bit of concern about what the future demand will be for office, and so we think conditions there will be somewhat weak over the next year. So we're keeping our underweight there and being very selective. With lodging and hotel REITs, while domestic travel has rebounded in many countries, we believe business travel and international tourism is still going to be at least another year away to getting back to pre-pandemic levels. And so we think there's still a lot there's still time before we'll see the potential for outsized growth there. And so right now it warrants an underweight. From a regional perspective, our largest weighting is towards the U.S. We are underweight versus the S&P Global REIT because we truly wanted a truly global portfolio with a better and increased allocation to other parts of the world, such as Australia, Singapore, and Canada. We do prefer the U.S. REIT sector. We believe the economic recovery is going to be the strongest and will actually lead the global economy in the recovery. But we also like Australia, Singapore, and Canada for the above average yield that we can get from those REITs, as well as the attractive valuation. Our underweight is primarily in Japan, as we don't see the valuation or yields as attractive relative to other regions. And with that, I'll turn it back to you. And on the next slide, I will conclude with, just again, the benefits of investing in a global real estate strategy. And as Manulife Investment Management, as your advisor, you get access to a deep expertise in global real estate. We have investment professionals around the globe that we can tap into, that we utilize as resources to help formulate our investment philosophy and investment process. And we take that information and put it through our disciplined investment process that we've used throughout the life of this fund, which is well over 15 years old. 15 years old. We believe the portfolio we constructed today offers investors an attractive yield that we believe is going to generate consistent performance over the long term by taking advantage of the new economy trends that we are seeing, the world's aging population, as well as the economic recovery that we expect to happen as vaccines continue to roll out. Back to you, Ned.
Thanks a lot. This asset class and the strategy of the fund is indeed very interesting and something our investors could consider for their future financial goals. Now for Rana, this is my next question. Can you share your outlook and forecast for this year and why our audience should invest? I think you're on mute, Rana.
Sorry about that. So we are talking about predominantly two themes: digital economy growing and manufacturing. At this juncture, if you can refer to the slide 4 for a moment, slide number 4. Yeah, that's fine. Thank you. So this to give a sense what kind of growth opportunities are out there. So in this slide, you can see that the smartphone penetration in India is at 65%, which is not that lower from China or US, which is at broadly, let's say 85%. Now, however, in terms of e-commerce penetration, you can see India as of now is lagging China and US far behind. This 3.2% has come after few years of 30, 40, 50% growth in the top line. So you can well imagine that this 30, 40% growth in the digital economy will continue for a long period of time before India catches up with China and US, in turn creating a lot of opportunities for companies and in turn creating a lot of opportunities for investors to invest into the stocks. In fact, this is one area which we are really excited about. Now we can move to slide 24 on. Yeah, thank you. And the second theme that we spoke about is manufacturing. Manufacturing, we are seeing a renewed interest in Indian manufacturing because of the better infrastructure the government has developed, the tax cuts which government has given, and also this China plus one strategy, where the global companies are looking for an alternative sourcing base apart from China. Few of the other things are also adding up for India as to be a manufacturing destination. If you look at slide 24 on the left hand side, you can see that average manufacturing wage in Asia and in India is actually quite competitive. And that is one reason why, if you look at the chart on the right hand side, the CEOs are preferring India after Vietnam as a location to produce outside China. There are a few more reasons, and we'll get into that. Next slide, please. So this slide shows the India's the smartphone volume by volume market. So basically, in the following slides, what we're going to show is that India is a large consumer market, and it makes sense, given the right incentives, to produce locally in India rather than import from outside. And once the companies who are producing in India gets a lot of volume, their costs come down, then they can use India as a base to export. So therefore, manufacturing gives rise to lower imports and then moving forward exports. This is an example of the smartphone markets. India's smartphone markets was number three, and I believe by the recent numbers they would already rise to somewhere three or number two. So it's a large and growing market. If you can move to the next slide. So this slide shows that the domestic market sizes for in India and the penetration. So as you can see, if you were to look at the slide if chart on the right hand side, the green bars, the India's market size is already not one of the largest outside China. And in spite of being such a large market, India's penetration level of the white goods, whether it's AC, refrigerator, washing machine, remains one of the lowest in Asia. Basically, what this means is that the lower penetration can give a long headroom for growth, and this markets, in spite of its large size, can grow at a pretty rapid pace. And think about what we discussed about digital economy creating more jobs, manufacturing creating more jobs. More jobs means more demand for such kind of white goods, which means the local demand is going to be strong. Makes more sense for manufacturers or the producers, the companies, to produce in India rather than import it and sell it in India. So therefore, because of the attractive domestic market, another impetus for companies to produce more in India, therefore rising the manufacturing share to GDP. Next slide, please. So this slide captures really, how we are positioned in the two main themes. Now, again, if I look at the two main themes on the digitization, the areas that is primarily impacted by digital economy is finance. The new algorithms, the new database, making the banks making the banks taking credit decisions, helping with them collections, payments. A lot of digital payments is a big theme in India. So financials, and thankfully the Indian financial listed financial companies are adapting to this kind of disruption. Therefore, they're staying ahead and not getting disrupted that much, because most of the banks in India, the listed banks, they have also invested in these digital technologies in over last few years. Right now, the time is coming to reap the gains from it. We are also seeing a lot of digital investments going to the healthcare, whether it is e-pharmacy or doctor consultation over the internet, so on and so forth. So we are seeing some investments and some exciting opportunities there. And the reason we classify energy in the within the digitalization bracket, because India's largest company, which is predominantly used to be an energy company, over last, and MSCI still classifies it as an energy company, but over last about 5, 6, 7 years, it has been putting all its incremental capital into three businesses: telecom, retail, and internet. So this company is investing into all those new age businesses, and therefore, whether it's telecom, whether it's internet, whether it is retail, or a combination of all of them, is leading the digitalization charge in India. And global companies like Facebook and Google, they have all invested into part of those ventures. So it's going to remain a big opportunity for us. The next thing we spoke about manufacturing, and most of the manufacturing opportunities in terms of stock market lies in the material sector, because India we see is gaining a lot of market share as far as the chemical exports are concerned. Now recall we spoke about the China plus one strategy. So we see the global chemical companies, they're looking for some other company to, some other country to source apart from China. And India has a lot of supply of skilled chemical engineers. It has a lot of land, labor available to put up those chemical plants. So in chemical, India is gaining a lot of market share. And MSA classify them as materials. So that is one sector where we are very optimistic. And overall, whatever capex is going on, the industrial companies, which are the capital goods companies or transportation companies, they are natural beneficiaries of manufacturing. The manufacturing percentage of GDP going up, so we like that space and we are overweight there. And I would just like to say that because of these two themes, what we discussed, and I would like to again highlight that these two themes also means that the country's fiscal deficit will come down as more and more business formalize, and it also means that the country's current account deficit will go down as imports go down, exports pick up, which means deficits go down. When deficits go down, savings are higher. You got to buy savings institutions. So within financials, we are also buying companies, right? Whether it's insurance, wealth management, so on and so forth. That is also going to be. There's also a theme that we are investing into India. So overall, by and large, overall, to summarize, a lot of opportunities, and we believe our because of investment process, which is growth, cash flow, scalability, and valuation oriented, integrated ESG, we are in a good place to harvest the returns while managing the risks. Back to you, Ned.
Thanks a lot, Rana. India equity is truly an exciting asset class to be invested in right now. India, being the world's next manufacturing powerhouse, is one equity market to watch out for. Well, that was a very insightful discussion. I hope our viewers got to take note of the points that you both shared. Now, at this point, let's shift gears and do something fun. Let's do fast talk. I'll throw away a short question and I'll have you both give me your top of mind answer. Game? So let's start with you, Joe.
Sure.
Favorite shopping mall? Hopefully, it's part of the fund's REIT holdings.
Yeah, it is. I have two. One is very close to the office in Boston called the Copley Place Mall. One is 15 minutes from my house called the Pheasant Lane Mall, both owned by Simon Property Group, which is our number one holding.
Great. Your investment philosophy?
Both professionally and personally, I'm a value investor. I like to buy stocks that are on sale and cheap.
Percentage allocation of your personal portfolio mix?
Since I still like to think I'm relatively young at 47. Right now, I'd say it's around 60% equities, 30% bonds, and then 10% REITs.
Great. Age you started investing? Maybe it'll give away more.
Yeah, around 22.
Okay, and last one, invest now, invest later.
Definitely invest now. It's always tough to find that perfect entry point. So invest now and continue to save if you can over time and continue to invest and lower your cost basis. So if you have a long horizon, there's never a perfect time to invest in now.
Thanks for sharing that, Joe. Now it's your turn, Rana. Game?
Sure.
Will India be the next superpower?
Most likely.
Okay. Biggest calendar year gain in Indian stock market history?
In the recent memory, in 2017, in US dollar terms, Indian market was up about 38-39%. Our fund was up more than 50%.
Very impressive. Your investment philosophy?
Because our investment, we are investors in emerging markets with a lot of growth opportunities. So it's predominantly growth oriented companies which grow rapidly, generate a lot of cash flow to reinvest back and scale up the businesses. So that's our investment philosophy: growth with cash flows at reasonable valuation.
Nice to know that. Don't put all your eggs in one basket. So how many baskets do you have?
Not too many also, because in that case, the diversification beyond a point doesn't make sense. So we like to maintain a right balance of baskets. How many baskets depend on the asset class you're talking about, or the investment objects that you're talking about. But right mix of baskets, I would say.
Thanks. So for the last question, 2022 bull or bear market?
I can talk about the Indian equities. We are optimistic. We expect the bull market to continue. However, I would echo what Joe also added, that the longer term, the 3-5 year outlook looks great. So one should be investing with a longer time horizon and let the money compound and grow over a period of time.
Thanks for sharing your answers with us, Rana. So thank you for both our speakers for their straightforward answers, but we're not done yet, because before we proceed to the Q&A, I would like to take this opportunity to acknowledge our media guests joining us from the audience. We have Philippine Star, Business Mirror, and Malaya Business Insights. So thank you very much for joining us today. And to our wonderful audience, we have more than 700 in attendance today. Thank you truly for sharing your Thursday afternoon with us. And we are now opening the virtual floor for some questions and clarifications that you may have for either of our guest speakers today. So I think I have already here a question that was sent in earlier. So let me see. I think it is for you, Rana. The attendee asked, given the current highs of Indian equity markets, is it a good time to immediately invest right now? Or is it better to wait and see for a couple more months?
We think it's a good time to invest even right now, because the kind of opportunities we have spoken about, the growth runway is really long. Now, we are quite confident that in next 2, 3 or longer 2, 3 or 5 years, there are significant investment returns to be made. So I would say the right time to invest is now.
Great. Thanks for your answer, Rana. I think this one's for you, Joe. Very interesting questions we've been getting here. It says here, given the increasing and intensifying negative effects of climate change, what REIT holdings are best able to avoid these potential risks?
That's an excellent question, and that's where I think even Rana has mentioned about how he's integrated ESG into the investment process, and we are doing the same here. And we do that through our analysis, looking at the individual assets within the portfolio of the REIT. You know, we look at where they're located, what are they doing to take, preventative measures. Are they upgrading their systems to become more energy efficient? Are they taking measures to make sure that they're sustainable over the long term? So we really take a bias towards the REITs that are definitely have a much more newer portfolio. They tend to be built with that sustainability in mind in terms of being more energy efficient, using less energy, or using the ability to put solar panels on rooftops to help make them more self-sufficient. And so we stress that to our management teams, and the management teams that we tend to focus on are already well ahead on addressing the issues of climate change. And so we stress that with our teams as we talk to them, and we think that's important because their tenants and their consumers that want to be in an office building or an industrial building want that in the properties that they lease. They want to be in buildings that are sustainable and are contributing to help fighting climate change, and so and that enables them to charge even higher rents. So we think it's not only good for the environment, but it's good business.
Great, thanks as well, Joe. I guess this one's back to you, Rana. India was hardly hit by COVID-19 early this year. Can we expect that reopening of the economy is underway and that we will no longer be disrupted by another spike of cases in the future?
Sure. I think the economy is now reopening already, and that is gathering more strength. Now, frankly, we do not know whether there will be a third wave or not. I mean, honestly, we don't know. But the point is, even if there is, one should be looking at the vaccination numbers right now. For example, there could be a small wave somewhere here and there localized in October. But I think that is not the big point. The big point is by November, December, you're expecting a significant opening up of the economy. I think even if there is some short-term hiccups, like a bit of third wave numbers, infection numbers go up a bit in the middle, I don't think the markets will pay too much attention to it, because the markets, in our view, and rightly so, are focusing on the vaccination numbers, not so much of the virus numbers. So I think that's what is going to happen going forward. So we have to track the vaccinations going forward.
Great. Thanks for sharing your thoughts on that, Rana. And lastly, I go to you, Joe. In 2018, your company launched the Asia Pacific REIT Fund in the Philippines. How is this global REIT fund different from that fund, and would it be a good idea to invest in both funds?
So the key difference between the Asia Pacific REIT Fund and our global REIT Fund is that we have the ability to go outside of the Asia Pacific markets. So being able to gain access to the European REIT markets, as well as the North American markets, US and Canada. So we have the greater flexibility to go where we see the opportunities, where we see better value at times, and we have the ability to shift our weightings accordingly. We could, at times where the markets in Asia, such as maybe Hong Kong, Singapore, or Japan, look more attractive in the US, we can shift more of our our portfolio to those regions, and vice versa. If we don't see the attractive valuations like we do today in Japan, we can allocate more to Canada, more to Australia, or more to the UK. So there's really, that gives us the ability to be more flexible. It also opens us up to a wide array of REITs, especially REITs have become more global in nature. So by investing in an Asia Pacific fund, and I do think very highly of the investment team that runs our Manulife Asia Pacific REIT team. We talk often about our markets and REITs, but you do get more of a focus on a particular region or even a particular subsector within those regions. But REITs have become more global over time, and so by investing in some of the REITs that are based out of the U.S. that have significant exposure in other economies gives us more options, gives us more investment choices to make. And I can't say pick one versus the other. It's like picking my favorite child. But there'll be times when the Asia Pacific REIT fund would outperform the global REIT sector, and there's times like what we've seen over the last year and a half, where the global REITs have outperformed the Asia Pacific REIT sector. So you could make a case to own both, or own just one. May depend on your overall investment mix in your individual portfolio. But we think equally both portfolios are very attractive to investors at the current time.
Great. Thanks, Joe. Thanks for sharing your thoughts on that. And I'd like to say, it's truly inspiring to be in an event with such engaged viewers. Thank you once again for those of you who sent in your questions. I hope you got great insights from our guest speakers. And with that, the time has come for us to announce our 2 lucky winners to receive 5,000 pesos worth of investment to any of our best performing funds. So our first winner is Joel Gonzaga. Congratulations to you, Joel. And we'd also like to congratulate our second winner. Our second winner is Christine May Debuyan. So again, congratulations to both of you, Joel Gonzaga and Christine May Debuyan. A representative from Manulife marketing team will reach out to you for instructions on claiming your prize. And just a reminder to our 2 winners, you must submit the necessary requirements to commence the application process of your initial investment. And that's a wrap. Thank you to our viewers who stayed with us to the very end of the program. And of course, to our esteemed speakers, Rana and Joe, who have shared their knowledge and insights with us. Any final message that you would both like to impart to our audience? Let's go with you first, Rana.
Sure. I think we will just like to summarize by saying that because of the growth of the digital economy and because of the growth of the manufacturing economy, the country is on the cusp of long-term sustainable and quality growth. This will create lower deficits, higher investments, better jobs, better infrastructure. Productivity all around will improve. Therefore, that will create a lot of opportunities for the corporates and for us investors in stocks. At Manulife, we have the right process and research capabilities to harvest the risk and to harvest the returns and manage the risk. So, I would like to say that these are a very good opportunity in Indian economy and in equity markets, and our strategy is rightly positioned to gain from it.
Appreciate that, Rana. And back to you, Joe. Any last words for our audience?
Yes, I would say, the time to invest in global REITs is very attractive at the current environment. Interest rates around the world remain low, and we don't see that changing in the near term as central banks around the world and governments around the world want to make sure we get through this pandemic and get the economies on solid footing before they take measures to increase interest rates. And as Rana mentioned before, I think a lot of the key is going to be what happens with the COVID pandemic. Markets are looking at the vaccination rates, they're looking at the cases, and that's going to really drive the markets over the near term. And we think the best play to play an economic recovery, which is the landlord of the economy across the globe, are REITs. As economies ease and reduce the restrictions and we get back to a more normal environment, demand for commercial real estate will come back. We've seen it already begun here in the U.S. Earlier this summer when cases were down and vaccination rates were high, and we saw dramatic growth in economic activity and the revitalization of going back to whether it's retail shopping, restaurants, etc. And so we think that this is going to be a multi-year recovery given all the stimulus that's been pumped into economies across the globe and a very accommodative central banks keeping interest rates low. So we think with yields at the very low levels, the attractiveness of the global REIT strategy with a 4.79% yield as of June 30th is a very attractive proposition for investors to consider. And lastly, I'll thank you for having me this afternoon. It's been great to be a part of this webinar. I just wish everyone to stay safe and healthy, and hopefully we'll be able to see each other in person very soon.
Thanks
Thank
a lot.
you.
Look forward to that. Making financial decisions, especially when markets remain volatile and uncertain, is not an easy task to do. But being informed of alternative investment opportunities out there and keeping updated of the latest market developments can help you better navigate these uncertainties. We hope that the information shared by our guest speakers today can help you make sound financial decisions for your future. We are excited to see you take your next step towards achieving your life and financial goals, because the right time to start is always now. If you haven't started your investing journeys, the best time to begin is now. Talk to your Manulife Wealth Specialist or Financial Advisor, or to your bank's relationship manager if you need further investment advice. And if you don't have a wealth specialist yet, please scan this QR code and a wealth specialist will be in touch with you. Before we go, we'd like to get your feedback. This will help us craft the next webinars. Please answer our short post-event survey. Just scan the QR code flashed on your screens. Again, this has been your host, Ned Chanco. It's been a pleasure engaging with you, and we look forward to seeing you again soon. Stay safe, everybody.
The world is changing, and investors around the world are becoming more sophisticated, demanding innovative solutions from wealth and asset managers. Combining our deep expertise and experience in both investment and wealth management, Manulife Investment Management offers fully integrated solutions spanning investment funds and pensions globally. Strategically positioned in key markets, our investment and client service operations are supported by seasoned investment professionals across the globe. Today, we are one of the leading global wealth and asset managers. What sets us apart is our 3 complementary global business lines to meet the unique needs of our clients. With our multi-product and multi-channel offerings, our retail investments arm brings institutional capabilities to retail investors, creating unparalleled investment solutions. While our institutional asset management arm provides a comprehensive suite of outcome-oriented solutions to institutions internationally. Our retirement arm offers an open architecture platform, which aims at providing best-in-class products and end-to-end solutions to meet the varied retirement needs. leveraging the strength of our parent company, Manulife Financial Corporation, which has a rich heritage and investment track record that dates back to the 1800s. We have access to a wealth of experience. With our strong insurance pedigree, we manage risks in a strategic and dynamic way. In Asia, our unrivaled presence and deep understanding of the region enable us to offer strong local insights and flexibility in customizing solutions for every client. It is our unwavering commitment in Asia that makes us a trusted partner of many across the world. Leveraging our local level expertise, as well as extensive global resources and network, we deliver solid investment results not just in public markets, but also private markets. Our long track record and deep capabilities in private assets means you can tap into a diverse group of assets to meet your unique investment needs. Through our differentiated, value-added public and private asset offerings and capabilities, we punch above our weight in delivering outcome-oriented and goal-based investment solutions to our clients. We achieve excellence in Hong Kong, where we power the largest mandatory provident fund provider, Manulife, and China, where we are the first financial institution to receive the investment company wholly foreign-owned entity license. The Philippines, where we are the first trust corporation backed by a leading multinational financial services group. And Indonesia, where we were awarded the top fund house. And this sums up our commitment to you. Manulife Investment Management.
Bro, anong gagawin mo pag nagkaroon ka ng milyones?
Magnenegosyo.
Anong business?
None of your business.
Eh kung mag-around the world na lang kaya tayo?
Saan ang unang punta natin?
Sa airport?
Nakareceive ka naman ng mga text na get rich fast?
Medyo alangayin ako sa mga ganyan.
Our goal should never be of the clandestine, to meticulously invest in that result in favorable ROI. And the thought alone gets me absolutely exhilarated.
Ha?
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 Kung yayahin ko na lang kayang makapag-date si Hart.
Kasal na yun, oy.
Aba, imagine lang naman eh.
Pag ikakasal na kayo, siguraduhin yung malapit kayo sa torre ng telco.
Bakit?
Para maganda yung reception.
Alam ko na. Ipapa-plastic surgery ko na lang yung mukha mo.
Pero,
Walang pero, nakakainis lang kasi itsura mo. Eh kung magpakain na lang kaya tayo sa mga kapuspalad.
di tropa din natin, tsaka pamilya yung pumunta ron. Pa-family reunion ka na lang sana.
Magtatayo na lang ako ng gym.
Bakit gym?
Para mag-workout lahat ng plans ko.
Ano bang plans mo?
None of your business.
Talent, position please.
Ready, direct!
3, 2, 1, action! And cut!
Buti na lang naisip natin to.
Dali lang pala.